Kailey, let's talk about the China story. It remains front and center for markets.
It does, and it's really weighing on risk sentiment around the world. The idea that cases are surging there and potentially could trickle through to other areas of the world as Chinese travelers are free to move about the globe once again. That is why you are seeing countries like Italy and the U.S. imposing new requirements, testing requirements on travelers coming from China. But it does really raise concern about the trajectory of the virus that we all have been trying to put past us. As a result, stocks were down broadly in Asia. The MSCI Asia Pacific Index as a whole down about 0.6%. But real underperformance was coming from technology stocks in particular. The Hang Seng Tech Index down by about 2.5%. And of course, the other consideration in the China story is whether or not it is going to meaningfully refuel global inflation and pick up demand for commodities and as a result weigh those prices. So that has been bringing bond yields up around the world, including in Japan. The BOJ, of course, trying to push back against that, maintain their newly higher yield curve control cap. But what's interesting is their bond buying, unscheduled bond buying that they conducted for a second day was only between maturities of 2, 5, and 10 years. So at the longer end of the curve, you did see yields moving higher. The 20-year yield in Japan up about 5 basis points to 1.32%. That is the highest going back to October 2014. What is interesting, though, is that even though the Bank of Japan is still trying to be dovish, the Japanese yen is stronger on the day. That could be a bit of a haven bid, and broadly, it is a weaker dollar story. But dollar yen today trading at 133.64. Kriti.
Well, Kailey, a little bit of a different story stateside, at least in early futures trading. Take a look at this. S&P 500 futures up about 0.3%. So you are seeing a little bit more buying in the U.S. session than you are perhaps in other regions of the world. But remember, I think this is also going to feed into the story that if you are worried about that COVID risk, if you are worried about some sort of repeat of 2020 or even 2021, these kind of new variants and potentially the Chinese kind of response, one of the big trades that has worked in the past is this flight to U.S. assets. That's exactly what you're seeing this morning with, I said, futures up, but also a bit into treasuries as well. You're looking at 385 on the 10-year yield. It's only down about 2 basis points, but still enough, just given it is a very light volume week, thin liquidity, our favorite buzzwords for the holiday. That's important to keep in mind. But remember, it's coming at the same time that you do have that commodity response as well, a slightly lower, and that by 2%. And that actually is, in a volatility-induced context, a normal margin of a move for NYMEX crude, now trading at a 77 handle. One of the fears here is that if you start to see the COVID cases spread more and more, specifically in Europe, does the NYMEX and Brent crude marks drop into the 60s handle? And that's going to be a trade that's going to burn a lot of people that are betting on higher oil prices in 2023. And of course, Bitcoin really following the story that you are seeing in futures. Remember, yesterday it was a little bit suppressed. So now I would call Bitcoin a little bit of a bounce back story guy, up about 0.4%.
I want to come back to that crude story, actually, because it is having an impact here in Europe. London is underperforming a little bit. You've got names like BP and Shell on the downside. Interesting that we did see that technology story in Asia, but actually technology is the best performing sector here in Europe. So the stock 600, the aggregate picture, absolutely flat, but it's actually popped over the last half hour. We're back just in positive territory, but it's been quite a rise as we've come through the initial hour or so of trading. What you are seeing, though, is anything kind of travel related under pressure. It's a knee-jerk reaction as we start to see some of these restrictions potentially be putting into place. The US, Italy, Taiwan, India, etc. You are seeing the airline stocks reacting to that. So Lufthansa, for instance, is down by over 4% today. And then you come back to that Brent crude story. Brent now trading 81.84. We're down by nearly 2%. That's feeding back into the equities, as I say. Technology at the top, but energy under pressure. That is why London is underperforming, Kailey.
Okay, so really it all comes down to that China story. So let's get more on that now, Guy. COVID cases are surging domestically with concerns mounting over the risk of new variants emerging. The outbreak, as Guy mentioned, has prompted a growing list of nations to require COVID tests for travelers from China. Let's get the latest on the ground now. Bloomberg's Alan Wan in Shanghai is joining us for the regional reaction. So, Alan, give us the China take on what the rest of the world is doing to its citizens or requiring of its citizens.
Well, what you were just saying earlier about the U.S. and Italy now imposing these new testing requirements on Chinese passengers, it's actually a bit of a. I mean, I think folks in China are by and large, they're upset a little bit, but they accept it. The U.S. testing requirements actually aren't very different from what China has been doing to the rest of the world over the past 3 years. And what these requirements are basically, is just like I said, is the negative test results upon arrival. But in lieu of that, if passengers can show that they've recovered or that they tested positive more than 10 days earlier, then that'll be acceptable. And also, the U.S. is also applying this to all passengers out of China, regardless of nationality or vaccination status. The reason U.S. health officials are, they do know what they're concerned about is the fact that China's lack of transparency over COVID data. What they're saying is that the rapid sudden increase of infections over a short period of time could lead to new variants. But for China's part, it's saying that if any new variants emerge, that it will inform the World Health Organization, and a global consortium tracking the epidemic has said that so far there haven't been any major significant variants emerging out of China, and that what we've seen so far here in China is basically what we're seeing in the rest of the world.
Alan, let's talk about numbers here. How many people are actually infected in China right now? Are we getting anywhere near the peak? What kind of information do we have on that front?
Okay. Well, China's CDC said today that the outbreaks may be peaking in Beijing, in Tianjin, and in Chengdu, but it's still pretty serious right here in Shanghai, as well as in Chongqing, and it's spreading fast in other provinces such as Henan and Jilin up in the north. And also the CDC said that it's probably going to get worse in the weeks ahead because of the Chinese Lunar New Year holiday. That's in terms of the numbers, I would say that accurate numbers are hard to come by. What we do know is the NHC has said that about 18% of the population, about 248 million people, may have already been infected in the first 20 days of December. And then there's Airfinity as well. This London research firm said that about 1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
These are incredible numbers. Alan, as ever, thank you for the update. We really appreciate it. Bloomberg's Alan Won joining us from Shanghai. Let's talk about the European response in a little bit more detail. Italy will begin testing all arrivals from China for COVID and is now urging other EU countries to do the same. This comes after almost half of the passengers on 2 flights to Milan from China were found to have the virus. Tommaso Edpart, our Milan bureau chief, joins us now for more. Tommaso, why has Rome decided to move on this without the rest of the EU?
It looks like, Italy is again at the center of the COVID pandemic. The Milan region official decided a couple of days ago to test passengers arriving from China flight to see which is effectively the rate of infection. And they found out yesterday that about 50% of the first 210 passengers tested had COVID. So this was an alarming sign, and the Italian health minister rapidly decided to then impose mandatory testing to all the passengers arriving from China, and is asking the rest of EU countries to do the same as a precaution. As we are speaking, Italian is sequencing some samples of the passengers to see if there is any new variant. The health minister yesterday night said we're not expecting a new variant, so we are not concerned in the short term, but obviously this is a key indication that also investors are waiting to hear. If there are no new variants, then vaccine that we have here, over 80% of the population is vaccinated in Italy, will be working, so that's almost fine. But if there are new variants, then that would be a different scenario. At the moment, the health minister say we are not worried about it, but let's see. Let's wait for the numbers to come.
Well, Tommaso, as you mentioned, Italy would like the rest of Europe to join them in this policy. What is the likelihood that the EU will do so?
So Italy formally sent a letter to the European Commission, said we can't be alone in this. We just found, an alarming number. We know in Brussels they are meeting today to make a decision. We'll see if the European Commission will decide to test all the passengers coming to China. This has not been decided yet. I think that the key point here is, again, the result of the sequencing done by Italian authorities. We're expecting it to arrive today.
Tommaso, great stuff. Thank you very much indeed for the update. Tommaso Ebhardt, Bloomberg Milan Bureau Chief, thank you very much indeed. Let's turn to the other story you mentioned at the top of the hour. Goldman Sachs CEO David Solomon has warned that job cuts are on the way. In his traditional year-end message to staff, Solomon said that the firm is working on a new round of reductions and that they are likely to be unveiled within a matter of weeks. Bloomberg's Danny Berger joins me now on set. Danny, what do we know about the size and scale?
Well, so earlier in the month, we learned it'd be about 8% of the workforce. That's about 4,000 people. So a hefty amount, more than usual for what Goldman usually lays off for job cuts, about twice as much. So this letter really just confirming the timeline, I suppose. He didn't say anything about the numbers in this letter itself, not a very cheery year-end letter, I might add. Basically saying that this will likely happen in the second half of January. He also blamed the overall macro environment, so tighter monetary conditions, slowing the economy, not really talking about their foray into consumer banking, which a lot of folks have blamed for overspending and the need to pull back, because Goldman did just finish up its second best year on record. So that on the surface doesn't explain why they'd be cutting so many jobs. It really is this profitability question.
Well, Danny, Goldman, it's not a surprise, sets the standard when it comes to industry hiring, sets the standard when it comes to salary. To what extent are they setting the standard for these layoffs for the rest of Wall Street?
Well, at least for the moment, Kriti, they are an outlier. Not an outlier in letting folks go. That is starting to happen throughout the industry. But Goldman is certainly doing steeper cuts than most. Again, it probably goes back to the fact that they had been spending and hiring a lot in a division which they're now trimming back on. For example, I was talking to Frederic Udea earlier in the month, the outgoing CEO of SocGen, who told me that they're not firing anyone additional from what they already had planned because Europe is starting from a better position. The outlier alongside Goldman Sachs might be Credit Suisse. Of course, they're doing a wide restructuring, so that probably explains that. But just to give you some of the numbers that Bloomberg has learned from other banks that, again, fall far behind Goldman. Barclays, they're going to let go about 200 people, according to people familiar. Morgan Stanley, 1,600, and Citi, just dozens, Kailey.
All right, I am sure we were going to get more details on this in the next couple of weeks once big banks start reporting results and the CEOs have to take questions on the analyst calls. Bloomberg's Danny Berger, thank you so much. Now, aside from Goldman, let's take a look at some other stock stories to watch this morning and those moving in pre-market trading. One I want to note is Tesla, because a rebound underway potentially for a second day. Remember, as of Tuesday, the stock was in the middle of its longest losing streak since 2018, but we saw a 3% rebound yesterday as some dip buyers came in, and that is continuing this morning. The stock up about 3.7% at this point, aided today by Adam Jonas over at Morgan Stanley, who published a note and said essentially the derating of the stock has created a buying opportunity. So maybe a lot of people are taking advantage of that buy the dip opportunity today. And it's not just Tesla in the big, large cap space of technology that is moving higher. You actually have a rebound underway for some of those other mega caps as well. Amazon, Apple, Nvidia, all up in the ballpark of between 0.6 and 1.2% at this point. And remember, they're all trying to recover some of what have been very, very steep losses for players of this size over the course of 2022. One group of stocks moved to the downside, though, in early hours. Really, the largest group of underperformers is energy. That has everything to do with the declines in oil that you and Kriti were talking about, Guy. ExxonMobil and Chevron each down about 1 percentage point before the bell.